Hey there, welcome to my YouTube channel. This channel is dedicated to helping home buyers and sellers understand the process of buying or selling a home. If at any point you get some value from this episode, hit that like button and subscribe to the channel to stay up to date. Enjoy the video. Hey there, today I'm with Christina, Cutolo, and Lally, a couple of rock stars and local hustlers with Cross Country Mortgage. As a real estate agent, I help people buy a lot of houses, buy and sell a lot of houses. So I deal a lot with mortgages and lenders working to obtain mortgages to purchase properties, but I don't really ever get to work with lenders on refinances. And it's questions that have come up to me before from people who have purchased homes. I've helped purchase homes. What happens when they want to refi? What is a refinance? What does that all mean? So today we brought in Christina Cutolo and Lally with Cross Country Mortgage to explain in depth what refinancing your mortgage actually means. So welcome, guys.
Thank you.
Thanks
Thank
for
you
being
for having
here.
us.
Thanks for coming and sharing your wisdom. So
Yeah.
you were nice enough to give us some questions I think that would be certainly great talking points. So thank you so much for giving me a little education right up front. Why don't we just start with, what's a refinance? What does that mean?
Yeah, so a refinance is basically simple terms of basically just taking your mortgage and replacing it with another one. And the reason why someone would refinance is lower interest rate, lower your term, take equity out, maybe consolidate some debt, things like...
Even if you wanted to go from an FHA loan to a conventional loan.
Drop PMI.
Drop your private mortgage insurance.
Divorce, remove somebody from a mortgage, or buy out a partner. So there's actually so many reasons why somebody would refinance.
So basically, refinance comes when you already own a home, right? You have obtained a mortgage, and you basically want to change the terms of that loan. Either you can benefit in interest rate or pulling money out. Is that right?
Yes. So it's a financial benefit. So when the interest rates drop, that's a good time for someone to refinance, because you're lowering your rate and you're saving monthly, or you're taking your mortgage from, let's say you have a 30-year fixed and the interest rates dropped so much, or you've had your loan for maybe 5-10 years now and you want to go into a 15-year. And so you're chopping off maybe 5 additional years and lowering your rate, and your payment's not changing all that much.
Really? So for as a refinance, a benefit to the buyers, you can actually restructure your mortgage, your loan, the terms of your loan, maybe save money monthly, and reduce the length of your loan, or pay more towards the principal. So one way or the other, it's usually it has to be a financial benefit to the person.
And also right now with values being so high and rates being so low, it's a good time to take equity out, maybe to pay for your children's college, to buy an investment property. That's actually a big one right now, because there's so much opportunity with pulling that equity out and investing it somewhere else with the interest rates being so low.
All right. Are there different kinds of refinancing programs?
So there's a rate and term refinance where you're just redoing your current mortgage. You're lowering the interest rate, you're changing the term of the mortgage. And then there's a cash out refinance. And a cash out is when you're pulling out the equity to do some consolidation, to pay for your children's school, to buy an investment property. So when you're pulling equity out, it's called a cash out refinance. And those are the two types of refinances.
So there's two options. There's a rate and term refinance, meaning you're changing or improving the rate of the term of your mortgage, or the cash out, meaning you get to use the equity that you developed in the home, the time that you've owned it, you pull the money out to use it for something else.
Yeah. Like and some people think,
to buy an outrageously expensive boat.
Yes, or a very expensive car.
Right, a very expensive car. Basically, you can use the equity in your home however you
want.
Fit.
Yeah. Right.
So the bank is you as the lender who's doing, let's say, a cash out refi. I want to go buy an outrageous yacht. And I have $1 million in equity in my home.
It's not necessarily the reason you want. I would say that's probably not one of the most common or the smartest.
Please, speak freely.
But you can do that. I mean, if
you can.
Yes.
I could if I wanted to, but probably not.
You're
advised.
adding another liability to your credit, but
okay.
unless you're paying cash, all cash. But yeah, you can go buy whatever you want. You know, I mean, it's your money, it's your equity. As long as you qualify with that and it works for the guidelines, then you can.
Are there different guidelines between a rate term refinance and a cash out refinance? Or are there?
Well, loan to value. So in a cash out refinance, you need to have 20% equity. So then that's post closing. So basically the loan, let's say your value,
So you have to have 20% after the refinance.
So yeah,
done,
so
right?
once the value comes back.
You can't start a refi with 80% loan to value.
So yes, you can. So we're structuring it so there's 80% loan to value, but there needs to be that value there based on the appraisal. So after you take out the equity. So
Right.
if so basically, if somebody came to me and their payoff right now, like their balance is 80%, then they really don't have the room.
Right. So let's just real quick explain to anybody out there who's thinking about trying to do something like this, pull some equity out, throwing around abbreviations like an LTV or loan to value.
Oh, sorry.
They may not.
Yep.
We may not know. Right?
LTV is loan to value, so that is the loan to the value of your home, and what we use an appraisal to determine that.
And in this particular instance, speaking about a refi, let's say, for instance, 5 years ago, somebody purchased a home with a 20% down conventional mortgage, right? Meaning they put 20% of the value as their down payment of the home, right? Now, over that 5 years, the home has gained value in equity, right? The loan has gained value because the market has come up, right? Now they have more equity in their home. And now let's say they're at a 60% loan to value. The amount of money that they owe on their mortgage is only 60% of what the home is actually worth. Am I on the right?
Yeah, because value in the last 5 years, especially now in this market, the values have gone up. So not only did they pay it down,
right?
They've
been for 5 years, they've been making their mortgage payments, which includes your principal of your loan.
Yeah.
So you're making, little benefits on the principal of the loan over the course of 5 years. And over that time, that balance has come down, value has come up, and now we have 60%. I only owe 60% of what my house is actually worth.
Yes.
That means I have not 40% to take out.
Yeah, you have 40% equity, but you don't have 40% to take out because you cannot take out 100%. And in this market and where the guidelines are right now, I don't know of any where you can take out 100% of your equity.
I don't think it'd be a good move for a lender.
I do know that,
right?
yeah, correct. And I do know that the Fannie Mae and Freddie Mac guidelines won't currently allow that. So unless it's a portfolio loan or maybe a hard money, that's not the case. Like you can take out up to 80% and a cash out. Now in a rate and term, we can go up to 95%.
95%.
Yeah, in
And do you
some
still
cases.
have the PMI at 95%?
So yes, so
PMI is private mortgage insurance.
mortgage insurance over 80%, 80% of your value. So there is, but you can go, we can go higher on that because you're redoing your loan. And in some cases, it's still worth it with the PMI because maybe the rate has dropped or, changing a term, so there's a lot still benefit in some cases. So what we do is we review that, obviously up front to see where's the financial benefit. And there's right now, especially, there's so many reasons why somebody can take advantage of a refi.
Okay. So, those are the different types of finances and refinances, right? So you've got your rate and term refi, your cash out refi. What is the process for applying for something like this look like for somebody?
It's the same process as if we were doing a purchase. We'd still do an application. We still collect all of the documents. Still want to do that pre-approval stage as well. And just make sure that it is going to have that benefit.
Yeah, and meet the guidelines. And we go through the guidelines on the refi. We have more programs. So if a homeowner, they already own the home. We do have other programs available now where, let's say, their income changed, maybe because of the pandemic. we have more flexible guidelines because they already own the home, and we can go higher on the DTI, which is debt to income ratio.
Oh, okay.
Compared
so
to a
it's
traditional.
Different. It is
Yeah,
dramatically
there's-
different from actually, applying for a purchase. There's more flexibility.
Yeah, when
in
you
the
already own the home,
refinance.
yeah, and it's not as stressful when you're going through the refi. Everyone's always stressed a little bit more because when you purchase a home, you're like, okay,
And when they're trying to buy a
just
home,
naturally,
it's a
yeah,
stressful situation
Yeah.
because everybody's putting all their documents together and waiting for the lender to say, okay, you're good, or no, sorry, it's not going to work out, right?
Right.
yeah, and you
Right.
still have to put documents together for refi, but
But you're already in the home.
you're already in the home, and there's not like a drop dead date.
Yeah, the bad news isn't like, well, sorry, you can't live in this house
Yeah,
anymore.
yeah, like we can't close on that. Yeah, so it's pretty similar to the purchase process in the fact that we do make sure they qualify, but there is more flexibility in certain guidelines and certain programs because they already own the home. So we do have to get documents up front. We do review them. We do submit to processing, and in some cases, appraisal is needed, and sometimes it is not.
Okay, so there is an appraisal with a refi as well.
There is.
On a cash out refinance, there's almost all the time there's an appraisal that's required. On a rate and term, it's really dependent on Fannie Mae and Freddie Mac, and when we run it through their automated system, it depends on the loan terms, the value we're using, the balance of the loan. So, and they'll let us know if we get an appraisal waiver, if an appraisal is required. So a lot of times, I would say more so than not right now, we're getting appraisal waivers on rate and term refis.
Okay, so there is some appraisal waivers on the rate and term refis.
Yeah.
Cash out though,
Not so much
as
because you're
likely.
taking out the equity. So they
Yeah.
want to make sure that you're taking out the equity, that the value is there. But it depends. There are once in a while we get them, depending
Okay.
like if it's a 60% loan to value,
Yeah.
more of a chance.
Are you saying you're putting together documents, reviewing documents? What is it? What do you guys need to see that would help you? Or it's your underwriters, correct? Your underwriters, like you guys put together the loan package, right? The
Right.
application, and you do your approval.
Yeah.
But then you put it to your underwriters for final approval. Is that right? So,
Yes, we do.
We do, and the documents that we collect are the same documents that we would collect for a purchase. So we would still ask for the bank statements, 2 months bank statements, your pay stubs, last 30-day pay stubs, W-2s. If you are self-employed, we would still ask for those tax returns as well.
Yeah. And if you own properties, additional properties, we'll ask for the mortgage statement and the tax bill and homeowner's insurance declaration page for the properties. And if it's in an association, we ask for the HOA bill. Because all of that, when you own other real estate, has to be included into the debt to income ratio.
talk to me, because that's interesting. I just had a client who was trying to purchase another home. When they own a home, it's rental property, right? So just maybe a slight sidebar. They had rental income coming in. How does rental income counted with when you guys are taking into consideration everything on someone's application?
Yeah, that's a good question. So rental income is if they own the property for 2 years, we ask for the last 2 years tax returns, actually even 1 year. So rental income, if they claim it, is based off of the Schedule E on their tax returns, and there's a calculation we have to do for income, for any type of income, and rental income is one of them. So we go through that calculation, and we use the number that we have that's calculated at the bottom of the calculator, and that's what we add to the application, whether it could be income or it could be actually a negative.
Really?
Right? So yeah, because just because you receive the write-offs, there could be a lot of expenses. Certain expenses are added back to it, and certain expenses are deducted further. So we do a calculation. If it's something that they just bought and they're leasing it out and they don't have tax returns, we use the rental lease, and we use 75% of their lease agreement for income.
Okay.
Sometimes, and then if it's not needed to qualify, we just don't even include it because we try to keep it as simple as possible. So if it's not needed, it's just less documentation that we have to ask them to provide.
We all love less documentation.
Yes, less documentation.
Less documentation
Less
is
is
great.
more.
Yeah, for sure. Talk to me about closing costs.
closing
The one
costs.
thing that everybody loves to talk about, closing costs.
Yeah,
closing
because
costs.
a lot of people think, well, I don't want to pay closing costs. It's not worth refinancing, which is not necessarily the case. There's closing costs on every refi in any state. Now, they can be rolled into the loan. They can be brought to
So you
closing.
can finance your closing costs.
Yes, you can, if there's enough equity in your home, which right now, most cases there's enough equity. We can increase the loan amount to cover the closing costs. So
Okay.
there's, just like on a purchase, there's closing costs for like Florida doc stamps, there's the recording fees, there's a lender fee.
All apply still with a refinance.
Correct.
Right.
Applies to a refinance, and they can be rolled into the loan, or you could, bring them to closing. But a lot of people just rather roll it in because it really doesn't make a huge difference in their monthly payment. The only out-of-pocket expense is the appraisal fee, if there's one required. The appraisal management company does require the fee to be paid up front in order to do the inspection.
Okay.
So, but everything can be rolled in, and when we're reviewing the mortgage, and if there's a benefit to the homeowner up front, we look at that. We break it down to say, okay, here's your closing costs. This is how long it would take to recoup. And most of the time, there's a pretty big benefit to refinancing either way.
Okay.
So,
Pretty big benefit to
Yeah.
refinancing
Like-
in a lot of situations.
yes, because if you're saving on your monthly payment, let's say you're saving $200 a month, you're going to recoup the closing costs pretty quick.
Okay.
A year and a half, depending on the loan size.
Right. And that's really, your closing costs are proportional to your loan size. Is that correct?
Yeah, so I would say, average 1.5% to 2%, but the higher the loan amount, the lower the percentage, really.
So average 1.5% to 2% of the loan amount is what you said, right?
Yeah.
Okay. So
But then again, if it's, $800,000, it probably it's a lower percentage because the higher.
the higher the loan, maybe it's 1% to 0.75%, something like that.
Correct.
Okay. Gotcha.
Average. Not
Average. All right.
Don't hold me to it.
And yeah, right. But you said, and to the loan amount, 0.75 to 1.5% of the loan amount. Is that the whole loan amount, or is just the amount that is
Yeah,
being
the whole
taken
loan
out?
amount.
So, okay.
Whatever the loan is on the application.
Right.
Yep.
So your old loan is basically gone. There's a whole new loan in place. That's what a refinance
Yep.
is, right?
So there's a whole, we're paying off the loan
Okay.
that they currently have, replacing it with a new one. And the new one is what we base all the
So
figures
if your mortgage right now is with PennyMac and I want to refinance with Christina Cutolo at Cross Country Mortgage, when I'm done with that, what I'm going to do is I'm going to first apply with you guys, right? I'm going to fill out some sort of application. You're going to ask me for my documents, my tax returns, my employment, all these other things.
Right. We're going to run credit, review that.
Run my credit, okay. And I'm okay to move forward, and I'm taking I'm doing a loan terms refinance. How long does that take? How long does something like that take?
So from the beginning to the end until closing?
Yeah, right. What we're going to do is we're going to replace the loan that I have in place. How long does that take to happen, and what's the end result? What does that look like on the other side?
So the whole process from start to finish is, I would say, 30 to 45 days
Okay.
on a refinance with our company. That's not industry-wide. And at the end, so we start with the application like we talked about, and then goes through our processing department. There's the underwriter reviews everything and gives the formal approval. And the formal approval is usually the conditional approval, and there's usually a few conditions that the underwriters ask for. Maybe some time has gone by since the last pay stub we received, and they ask for an updated pay stub, or maybe there was a large deposit we have to source in the bank, and they ask for documentation. Usually it's minor. We clear those conditions, submit it in for final review, where we get the clear to close. During this process, we get third-party documents like insurance updated with the mortgagee clause, the title. The tax certification.
So, real quick, title, something I didn't think of. Does title what's the work to be done with the title agency? And I'm familiar with a title agency and what they do during the course of a purchase, but I didn't even think about the idea of a title agency getting involved during the course of a refinance. Why?
Yep, they have to close. They're the ones that close every mortgage. So
do the accounting for funds and record? Is there
same? Yep. So we send the closing documents to them, but for the title work, they run the lien searches and make sure there's.
So all that stuff still needs to be done on a refi as well, not just a
Title.
transfer of
Correct.
possession.
Yeah. Yep. And then so in Florida, we don't necessarily need to use attorneys. We use title companies to do closings. And so they are the ones that handle our closings. And they're the ones that we send the closing documents to, and they coordinate the closing with the homeowners.
Okay.
And so from start to finish, it takes about 45 days. And before closing, we do get the payoff to see what the final payoff is at.
Yeah.
Which is usually a little higher than the principal balance because we have to collect, they have to collect the interest for the month that was skipped in the beginning when the loan was originated.
I see.
So 45
right.
days, I would say, 30 to 45, depending on how busy, the market is. And
Are you guys seeing any common pitfalls from people who want to refi? Who is it that you would turn away? Who are the type of people that you would say, well, thanks for applying, but we just don't think this is the best thing for you?
so, yes, so that's a good question. I don't necessarily, we don't turn people away in that. We'll let them know if they don't qualify because not everybody qualifies because if you have no income, chances are that, it's not the right time. But what we always do is try to give them a path or let them know at least what they need to do to qualify.
Okay.
I just don't like saying no, goodbye,
That's
but
nice. That's very nice of you.
yeah, if there's no benefit.
I mean, you say you'll work with people. If
I
they
will
don't
help
initially
them.
Qualify,
Yeah, as long as there's a
they can
benefit,
get it
obviously,
through.
I tell them if there's no benefit, I say this is not the right thing for you right now. It's not gonna save you enough, or if there's no financial benefit, I don't just refinance people just to refinance them. There has to be a tangible benefit to them financially, whether it's taking out equity to pay off debt, that's more than their closing costs, lower their interest rate, change the term. So there has to be a financial benefit, and if there isn't, then
So you do a pretty considerable amount of homework with a potential client before even.
always.
Oh, okay.
Yes,
Great. That's very
upfront.
nice. Sometimes that's not always the case. We appreciate,
Yeah.
I appreciate that you guys take the time to, because I've heard horror stories out there from other larger institutions that, first of all, they'll tell people that they do qualify, and sure, go ahead and do, but there's an expense with applying, right? That's, application, is the application
so
free?
We don't charge application fees.
Okay.
I am not sure what the banks or the big institutions do, like the depository banks. But we don't just take an application, put it through a channel, and say, we'll let you know when we hear back,
Okay.
and charge an application fee. We do our research up front, and we look at the guidelines up front, and we let them know if they're going to qualify. If we get to that point where I say yes, they qualify, they're going to go get an approval. We're not submitting something to underwriting without that knowing they're going to be approved. Now, the reasons why they wouldn't be is if during the process, let's say they lost their job, something we can't control, or they went and bought a car and their debt to income ratio went up because of that car payment.
Yeah, sure. That's the horror story we all talk about.
Those are the things we warn them up front not to do, but if somebody goes and does it, we cannot.
So let's talk about that a little bit, right? Because it's a joke, not necessarily a joke, sort of a running joke in the real estate, business
Yeah.
where,
Don't
you're
do
working
that.
with somebody and then they get excited and go out and celebrate and buy a bunch of furniture.
Oh.
Say when they're going to buy a home, they're applying for a mortgage and then they go
Yeah.
finance all their furniture at Rooms to Go or something like that and kill their credit in the middle of the transaction. And next thing you know, they don't qualify anymore to buy the home, right?
Yeah. That's painful.
So, are you coming across that at all? I mean, you do a good job
we
of
try to
coaching your clients.
Have those conversations ahead of time, with them, so that way they know not
Right.
to go out and make those large purchases in the middle of their loan.
Yeah,
Right,
so we
so-
tell them up front, like, when you're doing a mortgage, don't do anything with your credit. It's not a long process. You can wait. And if somebody needs something right, like let's say their car broke down and they have to get a car at that same time, I check the debt to income ratios and we make sure it will still work.
Okay.
So
So if you're in the
communicate
middle of
with your
a
loan officer.
refinance
Yeah.
or mortgage and you're having car problems or any other issues and there's
Communicate.
something,
Yeah.
make sure you that's what I love about this business and the way that we run things is
Yeah.
transparency is I mean, beautiful thing in my opinion about the real estate business is that it all comes out at the end, right?
Mm-hmm.
You can
Always.
try and hide stuff on your credit or
gonna
don't
see
tell
it.
anybody. It's all going to come out in the wash at the end,
Actually,
right?
that's a good point because when we run credit, we get notified in our system. We get like an email alert saying, homeowner ran their credit or applied for a new credit.
Oh, really?
Yes.
Okay,
And so we
that
have to
you
address it with them.
You have an alert set up on your, not that you do, but in your
Yeah, I'm
systems.
not stalking people, but
Yeah, you're not watching all your clients.
yeah,
you know.
it's part of the mortgage process. Like we get alerted.
So you get notified when somebody they do decide to try and go out and buy
Yeah.
a bunch of furniture. You're going to get notified.
We're going to
when
get
that
notified and we
happens.
have to address it. And then if there's something that they've opened, we have to get the statement or the terms of the loan and provide it to the underwriter and make sure the debt to income ratio still works. We have to add it in. And if their ratio is close, that can throw it off from qualifying.
Yeah.
It can,
Of course.
It's happened.
Absolutely. Yeah.
I mean, we try to prevent it, so it's very rare now where we see it in our team, but it does happen. Like if they're not, a lot of people don't know that. They don't know those things.
So the struggle is real. Don't go out and refinance, or don't go out and assume any more debt when you're trying to refinance
Correct.
or purchase a home. That's the honest to God's truth.
Yeah.
Right.
You will be, your credit can be
Don't buy the furniture.
compromised.
Don't buy a car.
Yeah.
Don't change jobs.
Don't change jobs. Don't lose your job.
Don't get fired.
Yeah. Don't.
Try to be good.
So, I have also, as an agent, come across buyers, and I assume with refinancing, it'd probably be the same thing. They want to shop around, right? I say, well, go talk to Christina about getting a mortgage. Go talk to Mary about getting a mortgage. And they're like, well, they gave me this outrageously high rate of 2.8%, right? Which, of course, we all know is very low, but and just
Right.
hypothetical. I'm not saying
Right.
that their rate is 2.8%, but you know what I'm talking about, right? And they're like, well, I think I can get a 2.7%.
You mean
rate.
it's not at 1.9?
Right, exactly, right. They're not giving me money to buy the house, right? So when somebody is, looking to obtain a mortgage or refinance, and they think that they can do better, maybe in closing costs or in the rate, do you recommend people shop around?
Yeah. I mean, I want anyone that's working with us to be comfortable with their decision. Shopping around, if you're doing it within, a certain time frame of us pulling your credit, then the next lender, let's say a week later, if they ran your credit, it's not going to put another ding on your credit. You can shop around within 30 days without having that, without it affecting your credit.
Yeah, I get that a lot. And the question that, people are like, well, I don't want them to run my credit. So,
Right.
and as an agent,
Got it.
I'm not hitting the credit, so I don't really know. I hear
There's no
from
way
other
to,
people.
Yeah. I say there's no way to thoroughly qualify somebody without running credit. And
Right.
so I can give numbers and ideas, but I wouldn't say, okay, you qualify without running your credit and knowing for sure. But you can apply with other lenders within 30 days without it dinging your credit.
So how does that game work, right? So does the credit, is it a soft pull, hard pull?
Tri-merge, hard pull. It's so that word hard pull is it sounds so much worse than it is. I mean, if you have good
Does
credit,
sound kind of malicious.
yeah, and as long as you're not running it all the time, it's not going to be your score isn't going to drop dramatically. It's really when you're running it. Let's say this month, and next month you go buy a car, and then the next month you're applying for credit cards. Multiple inquiries really is what drops your score. And if you have excellent credit, that's really not something to be worried about if you're applying for a loan once in a while. I find it the ones that have the lowest credit scores are the ones that are concerned about running credit, which to me is a little bit.
That's a good indication. You don't want are you
Like-
sitting so close to the line that one soft pull or hard pull or whatever is going to put you out of the game?
Yeah, that, and also if this could be a big financial benefit to you and your credit is, you're already concerned, I really wouldn't say that this is the worst time decision of all the inquiries you've done or all the things that you've done to your credit. This can actually help if
Right.
it's going to give you a financial benefit,
Right.
maybe pay off some credit to
Right.
increase your score.
It would probably be what you're saying is probably a better financial decision to allow a lender to run your credit to see if they can save you money on their
Right.
rate, reduce the term of the mortgage, or reduce your monthly payment,
Yeah.
rather than run your credit at Best Buy to buy that 85-inch TV.
That's exactly.
Is what you're saying. Why don't we just summarize real quick about the refi? Because, and a lot of buyers, they don't know. They don't know. I mean, most people not in the real estate industry buy on average every 7 years. They refi, who knows what. Why don't we just wrap it up, summarize the refi process real quick? Like, who's the best again? Who's the best person? Who's your optimal client for a refinance?
Someone who right now in this market has equity that has a higher rate than where the market is currently, which is, oh my gosh, it's like everyone. So everyone,
right. everybody who's bought, like, say 5-6 years ago,
even
is paying
actually
a higher rate.
Yeah,
even 3 years ago,
even
probably,
a
right?
year ago. We're refinancing people from a year ago because, let's say, right before the pandemic or right when the pandemic started, they bought their home. Yeah, they put 5% down. And then in 1 year, they gained 20% equity. Yeah, the ones I really like helping, I mean, I like helping everybody, but I really enjoy the ones that have private mortgage insurance and have put down less than 20% and maybe have a little bit of a higher interest rate, or maybe their interest rate's the same as where it would be now, but we can remove their PMI. We could take it from FHA to conventional and drop PMI, which could be like a good amount, like $250, $300 in some cases
that they're saving.
And that's they don't even realize it. So I just ask people to send me their mortgage statement, and then we do the calculations and just say, here, these are your options and different ways of doing the refinance and how you can benefit from it.
Mm-hmm. That's the awesome part about doing these interviews outside, right? So the perfect client has, bought within, for a year or earlier, right? They've got equity, they've got good credit. How do you treat self-employment income? How does that affect?
Yeah, so self-employment is, generally speaking, last 2 years tax returns. In a lot of cases, we can use 1 year tax return. Yeah, and now we have other programs where we're helping more self-employment homeowners get qualified because of just the different portfolio options we came out with. So, but more than likely, if they already own the home, they've
already qualified for the mortgage.
Unless they've changed companies or they opened a new one, just different reasons why maybe they don't qualify right now, but there's a better chance they do if it's how they bought the home.
Yeah. Are the lenders, do you find, are the lending companies treating self-employment income slightly differently than they used to now? Because seeing a lot more self-employed people out there. I mean, with the gig economy, with people driving for Uber or Lyft or DoorDash or all these are all contractors now. There's so many more contractors out there and self-employed people than there used to be 5-10 years ago.
It depends. I would say every lender has their own overlays. I can only really speak for, I know that it's still it's really challenging still for certain homeowners that are self-employed to get qualified if they've had less than 2 years.
Less than 2 years of self-employment income.
Yeah, but we have certain options. I don't know. Every lender is different when it comes to their portfolio options, but we have certain options where if they have less, like let's say they started their business a year ago, but they were in the same field as a W-2 employee, sometimes we can make that work.
Okay.
And use 1 year. So we get a little creative. We read the guidelines the way they should be read, but we also have other options that can work. That's like saving them, saving the refinances, and helping them qualify. So.
Gotcha.
Tongue twister there.
All right, cool. So you're with Cross Country Mortgage. You guys are with Cross Country Mortgage.
Yeah.
Independently owned and operated? Are you employees? Are you contractors?
We're employees of Cross Country Mortgage, and Cross Country Mortgage is a national, it's a national company. We're licensed in every state.
It's a large lender. I see them. Yeah. I see Cross Country everywhere. I know you guys because you're here in the office with us, and I've had the pleasure of working with you.
It's a great company.
Yeah,
I love it.
Cross Country is everywhere.
Yeah, we're really taking over.
Yeah,
we're across the country.
We're across country. Absolutely.
Everyone it's just a great company, but we're employees of the company. We don't we're not independent contractors.
Okay.
But we're not like we don't get paid unless loans close. So we
You don't
have
get paid unless loans close.
Yeah, we're not.
That's important.
Yeah. So I mean, we want to make it work for the client, but we're also not going to just close loans. Just it has to be a loan that's where the company's not going to, they need to be able to sell it to the secondary market, and we don't want to take on we don't want to close loans for homeowners that maybe it would have a negative impact on them.
Sure.
So it has to
bottom
make
line
sense,
is
but we have flexibility, and we know that we understand common sense too.
So in talking to the people who want to purchase homes and trying to get mortgages or even refinances, I hear it a lot that well, why shouldn't I just go with my big bank with my where my checking account is? I've got my savings account over at
Right.
large corporate bank.
Yeah, we get that all the time. So
what's the benefit? Why should I send somebody to you versus a larger?
I would say the number one thing is customer service and our turnaround times. And we specialize in mortgages. That's all we do. We don't open checking accounts. We don't open savings accounts, car loans. Banks are great in that aspect. I don't necessarily think that mortgages is where they specialize, because when you work for a bank, you're doing so many different things. People are coming in to apply for different types of loans, not just one type. We're licensed, and I don't even think that you need to be licensed necessarily to work at a bank. I'm not saying that it's their banks are, great. They're Chase, Wells Fargo, Bank of America. They're great banks, but when it comes to the mortgage side of it, I do think that we specialize in that, and that's where they actually, I think, they prefer us to originate it, and they buy it from us in the secondary market. Their overlays are way more strict than ours. They'd rather us take on the risk up front and buy it from us.
Tell me about an overlay. I don't know what that word means in this.
So an overlay is we have the base guidelines that Fannie Mae and Freddie Mac put out to the industry that we have to follow.
Guidelines meaning
rules.
People who qualify for the type of rules, right?
Rules. 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 I don't know if that's the right word.
Right, rules, roll R's, chiseled in stone. So the rules that they're basically rules that people have to abide by in order to qualify for. Is that what I
Right. It's
understand?
the standard policies that they require lenders to follow. Mm-hmm. The guidelines for the debt to income ratio, the loan to value, the if you have like student loans, if there's just so many different guidelines. I can go through them all day. But
which is a lot
there's
more
the base.
complex than what most of us would think.
Yes, it's not just like, okay, I own a home, I should get this refinance done, and it's not going to. There's guidelines we have to follow, but we have the base guidelines, and then there's lenders that have overlays on top of them, meaning they add their own rules or guidelines on top of the standard.
Okay.
So we don't have that. We follow maybe one or two here and there, but for conventional FHA and VA, the standard traditional loans, we follow the guidelines that are enforced by secondary market, which is Fannie Mae and Freddie Mac and FHA. So when there's overlays, banks, almost every bank has overlays. You need to fit into their box, and if you don't fit into that box, you're going to run into issues. Not only that, on a refi, we have a visitor. On a refi, it's taking them, from what I hear, which is every day, I hear this, 4, 5, 6 months to get them done.
4,
Especially
5,
right
6
now.
months. Wow.
With so many,
Goodness.
Everyone's purchasing, everyone's refinancing. I mean, refinance is more so last year, but still, there's so many of them going on still. It's just, they're so busy.
Probably overwhelmed.
They don't have the, they don't have the staff really to turn those around quick. But we have, like I said, we have a great system, and ours are, luckily, we're still closing within 45 days.
Awesome.
So I would say it's customer service, number one, just because we're going to communicate all the time, and we specialize in mortgages. We have a process that we are continuously improving, but I feel is very streamlined in most cases.
And you said that you don't really, you may make a certain salary, outside of commission, but you really don't get paid unless the deal closes, right? in my opinion, that means you would put a lot more effort into right up front advising a client or a potential client of how they need to qualify and what they need to do in order to actually close that transaction.
Yeah, I mean, it's not like I'm sitting there thinking about what I'm getting paid.
Right, no, none of us are.
But yeah, we don't, we're not just saying, here, fill out this application and we're going to submit it to our underwriting department and then let you know when we get a response. And then,
you don't hear from us for
right. It doesn't work that way. We actually, I'm not saying other lenders don't care. They care. I can just speak for how we work, and we do our due diligence up front and spend the time, because the last thing we would want to do is put somebody through a process that it's not going to work and get their hopes up.
Yeah,
and
it's like
experience. I said in the beginning, local reputation. Like if you sent one of your clients to me, you're sending them to me because they're going to be taken care of the right way.
Absolutely.
And it's going to be a reflection on you too. So we have that relationship, and we want to make sure that we're doing the right thing up front. And I just think that's the right thing to do, is make sure you're giving somebody the right opinion, the professional opinion they're coming to you for up front.
That's what I always think is, one of the main benefits of using somebody local rather than, call my lender in Michigan, because as a small community, and we are, realtors, lenders, title agencies, all the locals, we all know each other, we all very, we see each other every day. We talk to each other. We do transactions together, and our local reputation is extremely important, right?
Oh, yeah.
So if I was to refer somebody to whoever and I get a bad report, I'm never going to refer anybody to that person again.
No,
and not only that, but I might share that experience with, some other agents, or, not necessarily to be, talking poorly, but say, look, hey, I had this very bad experience. Be careful, because it's not a matter of I get a bad report on somebody that I refer. In my business, my philosophy is that I'm only as good as the people I refer anyway, right? So if I refer somebody who a client of mine has a very poor experience with, it's a poor reflection on me as well, right? So our local reputation is of utmost importance amongst our peers. And so...
Yeah, I mean, Mary knows that how big are we on customer service? Like, I
communicate constantly to whether it be the agent, the buyer, the title company, just making sure that everybody is kept in that loop.
Yeah. Weekly.
Yeah.
Daily.
Yeah, right, sure. So you guys put a lot of emphasis on keeping everybody up to speed, up to date.
Yeah.
Awesome.
Yeah, we
Very
do.
good.
It's important.
And that's, I think,
like
would
you said,
be
transparency is important.
Transparency, accountability, honesty, and in my opinion, what's really important to me in my business is putting other people's needs ahead of your own.
Yeah.
And, I've definitely seen you guys, do that with the people I've referred over to you. So I'm very confident.
And we've seen you do that too.
Well, thank you very much.
You're very good at what you do.
Thanks, I appreciate that. So, where can anybody who's interested in refinancing their mortgage, where can they find you? How can they get in touch with you?
So you can call us, you can email us. So
Yep.
Okay.
Let's get the phone numbers. Let's do it. Let's get phone numbers, email address, websites, Twitter accounts, whatever it is. Facebook, Instagram.
LinkedIn, Instagram.
We draw the line at fans only, though. All right. So
no fans only.
Is that appropriate?
Yeah. So my phone number is 561-713-8740. And my email is Christina, CHRISTINA, C at myccmortgage.com. And you want to give yours?
Absolutely. My phone number is 561-427-8268. And my email is mary.lally, MARY.LALLY at myccmortgage.com.
Guys, thank you so much for taking the time.
Yes, thank you for having us.
I hope that anybody out there watching the video finds some benefit.
Yeah.
Guys, feel free to reach out to them.
If you have any questions,
they're a wealth of information. So thanks again. I appreciate it.
Thank you.
Thank you.
All right. Thanks for watching the show today. Make sure you hit those like and subscribe buttons if you got any value from it, and hit the bell icon so you'll know when the next episode comes out. Put your questions in the comment section below, and please let me know if there's anything else you'd like me to cover. Thanks again for watching. We'll see you next time.